Hello, hello, hello. Welcome back. Welcome back to my channel, the Cheryle Hubbard Show. Glad to see you. Glad you can join me. Glad you could be here. So today, just want to talk a little bit about accounting. Just a little accounting tutorial right here on the Cheryle Hubbard Show. So now in the past, I have done a few other accounting tutorials. So this is just going to be, like a little review. And sometimes I do my little business segment. So after this accounting tutorial, I will probably talk a little bit about, a little bit about my business and update you on how Cheryle Cosmetics is coming along. Okay, so first of all, this is just a little accounting tutorial. Just gonna be a little review. Let's talk about some first we want to go over some terms, and then we want to go over some, T accounts, debits and credits, and then, maybe go over a few transactions, and then we'll wrap it up, probably after the T accounts and the transactions, and then I'll go over a few, let you know how Cheryle Cosmetics is coming along. So, first of all, let's start out with what is accounting. So accounting is a system that measures business activities, processes that information into reports, and communicates the reports to decision makers. So in other words, accounting is a system. Basically, it's a system. It's like an information system. Whatever type of business you're running, you will need an information system. So if you're running an accounting firm, you working in whatever business you're working in, or you running whatever business you're running, you may have your accounting department. So your accounting department may be that separate entity from the other parts of your business. So if you're running a business and you have your accounting department, you want to, create your information system. You want to create your accounting information system. So all those accounting activities and reports, when they are gathered up in one, I guess you would say one particular segment of information. You might have another segment. You have accounting. There may be one segment where you gather all your accounting information. You gather all your accounting information. Then you have another. You may have your human resources department. You may have different departments, but then you also may have your accounting department. So in other words, your accounting department, you gather your reports, your activities. Your activities are written up into reports, and then you make it up that's how you will make up your income statements, your balance sheets, and your statement of owner's equity. So, and then basically accounting is considered the language of business. And it says the better you understand the language, the better you can manage the financial aspects of living. So accounting is basically an information system. You gather all that accounting information. How much money do we have coming in our business? How much money do we have going out? You're creating the statement of cash flows, and you put that information into your statement of cash flows that's coming from your business. How much money you have coming in, how much money you have going out of your business, because you want to know, hey, can I expand? Is this the time for us to expand our business? Is this the time for us to purchase new equipment, machinery? Is this the time for us to hire new employees? Is this the time for us to buy some more land and buildings? We want to, in the future, we do want to expand our business. We might want to purchase some land where we can build another part to our business, where we can have we could be operating something different on this part of our land, and then we'll be operating some other stuff for our business on another part of our land on our business. So in our business rather. So accounting information systems. You got your income statements. You gathering up your reports. Income statement. Revenue minus expenses equals your net income. So whatever revenues you have for the accounting cycle, the accounting period, what revenues have you added up? Have you generated rather? I mean, service revenue. I mean, your revenues are, in other words, if you run a beauty salon, hair salon, revenues come from your goods and your services. So in other words, your goods and your services, whatever services you are rendering to your customers, that will come under service revenue. And then whatever you're selling, that's still your revenue. That's money coming into your company. So as I said previously, statement of cash flows. What amount of money do you have coming in? What amount of money do you have going out? And a lot of times people talk about bookkeeping. Bookkeeping was something that we would study. Back in the day, in high school, you might have taken a bookkeeping course. So bookkeeping is just one element of accounting. So in other words, accounting is broad. It's a broad topic, I guess I would say. And bookkeeping is just one element of accounting. So also, when you're gathering up this information and in your accounting, I guess I would say in your accounting department, from your accounting department, when you're gathering up this information, you're gathering up all this information for the decision makers. So managers, so I guess I would say financial accounting. Financial accounting is where information is gathered for your outside decision makers, your creditors, your SEC, Security Exchange Commission. So that's the financial accounting reports and records. That is used for your your creditors. You get a loan, you run a business, you buying products, and you might buy something on credit. They might want to look at your reports, your records for your business. How well is this company doing? Can they pay us our money back? You want to create accounts payable. So you want to create accounts payable. You want to buy supplies, merchandise, whatever you want to buy for your company. They want to know, hey, you build up your credit and you keep your credit up. You pay your bills on time. You go to somebody else's business, you say, well, I'm running this cosmetic company, like my company, Cheryle Cosmetics. I'm running a cosmetic company. I need my oils. Say, for instance, I need my oils. This is well, it's a vitamin E, so I don't know if you can see that or not. This is vitamin E oil. Vitamin E oil. And this is also jojoba. Trying to see why it's not showing, but well, that's jojoba. And then also I have raw mango butter. So in other words, you need to purchase some products. You need to purchase some products. Your oils, your jars, your labels, and also I might want to purchase my custom packaging. Cheryle Cosmetics, and also my business card. So running your business, whatever product, whatever inventory you need. So in other words, I want to buy things on account. I want to create accounts payable. So I have to, as a company, I want to keep my credit up, and so they will come under financial accounting. So outside decision makers. So they will be making a decision of whether or not they want to lend my company money according to my credit. But managerial accounting, that's for inside decision makers, the managers. Managers need to keep up with their accounting books, their accounting records. 9 times out of 10, they will have an accounting department as well. So they want to keep up with their county records, the county reports, income statements, balance sheets, statements of owners' equity, and that way they want to know how they're doing at the same time. They want to know how they're doing. Can we hire more employees? Do we have the money to pay these employees? We need new uniforms. We need to strip these floors. We have to buy inventory to strip. Say for instance, by about 100 floors. We want to we have to keep up with those books. So that's So then next I have I want to talk about next. So once you learn all these terms. So in other words, the terms. In other words, I said you have say for instance you have assets. You have assets. You have liabilities. Owner's equity. Say for instance we have land, buildings. We have and also we have cash. We have so next will be, we already talked about we just talked about financial accounting, managerial accounting, and accounts payable. In other words, when you want to purchase inventory for your company, you might not want to pay for everything at one time. So liabilities. So that you will be creating a liability. So these are the terms. So liabilities, assets, and liabilities. Those are two terms that you want to separate it. You want to say which ones are assets. You want to name assets. You want to name some liabilities. That way, when you create your T accounts, you make yourself familiar with all the assets, all assets. All the terms all the things that are considered, I would say it like that, all the things that are considered to be assets, and then you have things that will be considered to be a liability. So liabilities are your debts. Your debts, you owe creditors, you owe your creditors, you owe, like I said, you create accounts payable, that will be a liability. And you have your assets, then we have our owner's equity. Owner's equity, how much equity do you have in your business? In other words, you invest in, say for instance, you invest $100,000 in your business. You invest $100,000 in your business. We would debit cash, $100,000, and credit owner's equity. So $100,000 would be equity that you have in the business. And then land is considered an asset. Land is an asset, and building is an asset. So assets are those things that can give you future value. In other words, land, building, owner's equity, that is an asset, and then we have the liabilities. So, in other words, you invest $100,000 in your business. You want to debit the cash account. In other words, you have starting out with your business. You want to debit cash. I guess $100,000 in Cheryle Cosmetics for $100,000. So we have debits on the left, credits on the right. Debits on the left, credits on the right. $100,000. I want to debit my cash account, $100,000, and this will be my owner's equity. Or credit my owner's equity account, $100,000. So that's how I would do when I start investing in my business. So like I said, first things first, you would, when you start off just learning accounting, these are just the basics that I'm giving you. So first of all, you start out, like I said, you refresh your memory, or you just make yourself familiar with accounting. the term accounting. Make yourself familiar with accounting, the definition of that, and then you go on to make yourself familiar with different terms, revenues, expenses, counting, revenues, expenses, different terms. You make yourself familiar with those terms, and then once you make yourself familiar with certain terms, and then you come to the T accounts. So we have assets, we have cash, we have office supplies, merchandise, furniture, land, building, expenses. Expenses would decrease owner's equity, and expenses would decrease owner's equity, and also liabilities. So your expenses, your rent, your electric, your gas, you have to pay. You have a salaries expense. You have to pay your employees, so that would come under expenses. You have to pay you have a liability to pay your creditors, just like McDonald's and Wendy's, and say for instance, even Cheryle Cosmetics. Like I said, I want to buy some products. I purchase labels. I purchase all my labels from Avery, so that would be part of my inventory. And then also I have my business cards. Not my business cards, but my postcards. So now, if I want to purchase inventory, but I want to purchase everything, I don't want to purchase it on an account. I don't want to create accounts payable. I want to buy my inventory, and I just want to pay for it straight out. So that would be, inventory is still considered an asset, but then if I want to create an accounts payable, like I said, I want to create an accounts payable. Say for instance, I want to purchase, like I said, custom boxes. I want to purchase my custom boxes for my business. Custom boxes. All my oils and everything that I need, business cards. Everything that I need, all my shea butter, cocoa butter, mango butter. So I want to purchase those things, but so if I want to purchase those, it will come under office supplies. Say for instance, I want to purchase, say about $500 worth of office supplies. So if I want to purchase some office supplies, since I want to purchase office supplies, I'm creating an asset. Office supplies, $500, and I want to purchase office supplies, I can take it out of cash. I want to credit my cash account, $500. Office supplies, $500. Cash, credit. See, I'm crediting cash because it's coming out of the cash account. See, you debit and credit. Office supplies. See, office supplies is an asset. Cash account is an asset too. So office supplies, I'm going to debit my office supplies because I'm creating an asset. I'm buying office supplies, and I'm bringing office supplies into my company. So that's $500. That's debit to office supplies and credit cash because I had to take it out of my cash account. But if I wanted to, say for instance, I purchased some office supplies, or even like McDonald's or even Cheryle Cosmetics, $500. McDonald's purchased $500 worth of, say for instance, burgers, rolls. McDonald's purchased, hamburger buns. McDonald's purchased $500 worth of hamburger buns, but they created accounts payable. They created accounts payable because they didn't pay for it all at one time. So I'm going to credit accounts payable. So debit's on the left, credit's on the right. Credit accounts payable $500. And it still would be, if it's McDonald's, they probably wouldn't call it office supplies. They probably would call it maybe inventory. It still be the same, but it still would be creating an asset. So when you don't pay for it all at one time, you know, you're creating accounts payable, because you created an accounts payable because you're gonna have to pay that company because you bought merchandise on time. You created accounts payable, so you're creating accounts payable. But the other company on their books, they would be creating an accounts receivable, because they're gonna have to receive the money from you once you start paying on that accounts payable. So let's see what I have next. Okay, so we have expenses, we have assets, we talked about revenue. So revenue, accounts earned by delivering goods and services. I talked about accounts receivable, and also when you write things down, you go to a company, you want to purchase some merchandise, you want to purchase something as an account payable, but you want to have it written down. The company will write it down, would be a notes payable. So writing it down on paper and creating a promissory note. In other words, there's a promise to pay. That would be creating a note payable. And also you can create a note receivable. Or you writing it down, the company writing it down, and they will be receiving money in the future from you, because you created an account payable, but they're receiving the money from you in the future. So when they write it down as a promissory note, and they give it to you so you can promise to pay them in the future, they're creating a note receivable. So, okay, let's talk about, let's talk about an income statement. Okay, an income statement is revenues minus expenses. So, revenues minus expenses. Revenues minus expenses equals net income. Revenues minus expenses. So we have revenues minus expenses. We have revenue. Say for instance, revenue. We have service revenue. Say for instance, service revenue $8,500. We have service revenue as $8,500. Then we have expenses. We have expenses. Say for instance, we have expenses. We have salary. See, we have to pay our employees. We have salary expenses. Say for instance, that's $1,200. And we have rent. We have to pay. Say for instance, we pay rent on our building. We pay rent. That's $1,100. We run a business. We have to pay our rent. We have to pay our employees. We have our utilities. $400. So our total expenses. Our total expenses $2,700. Total expenses $2,700. And so we'll take our total expenses and minus it. We take our total expenses, which is $2,700, and minus it from our revenue. Like I said, expenses minus revenue. Take your expenses from your revenue, and it'll come down and give us $5,800. So we have revenue, we have service revenue, we have service revenue $8,500. We perform some service, we may cut some hair. We cut some hair. We performed tax services in our law firm, or even Cheryle Cosmetics. I performed the service. Say for instance, I put some perms on some customers' head, and I put perm in some customers' head. Or somebody working at a salon. Let me see who that is on the phone. So we cut some heads. We cut some heads, and we put custom hairs, and then that's like, you know, barbershop or hair salon. So, okay, so service revenue. Okay, so total would be $5,800. So revenue minus expenses, that's the income statement. So revenues minus expenses, that is the income statement. So like I said, service revenue $8,500, and then we have this revenue, our expenses, our salary expense, salary. Let's see, expenses. We have salary. We have salaries. We have to pay our customers. We have to pay our employees, and our rent $1,100. So total $2,700 minus $8,500. They gave us $5,800. See all that chalk paint have all different colors. Okay, so that was an income statement. And then the balance sheet. Balance sheet is assets. Assets, you know, you have a balance sheet. Balance sheet is your balance sheet is like a snapshot of how much, I guess, how much you have in your business, how much your business income is for that particular period. It's like a snapshot. And at that particular point in time, so in other words, your figures may change later on. So in other words, you do an income statement, you're doing a balance sheet, and you might have a particular amount that you're recording in your accounting books, and then it's just a snapshot for that particular point in time. So that's what that is. Okay, so balance sheet, we have your assets. Assets. In other words, you total up all your assets. Total of all your assets. Oh, let me see. Hold on, excuse me. Hello?
Hey, I was calling you behind.
Yeah, what's up?
Greg said he got some apples. Do you want them?
Oh, yeah, I'll take some.
Okay, he coming downstairs to check my mailbox because he forgot to check when he came up. So he coming down with the bag of apples.
Oh, okay. I'm going to go to the door.
Okay, bye.
Okay.
Bye.
Mm-hmm.
Bye.
Yeah, my neighbor wanted to know that I want some apples. I thought there was something going on. But, so, balance sheet. Total up all your assets. And then you want to total up all your liabilities. Total up all your assets, total up all your liabilities. And you're going to take your liabilities and add them to your owner's equity. And they should equal on both sides. Just an example, it came out to $5,800 over here, so you want $5,800 over here. all your assets. Say for instance, your assets just an example, you have land, building, office supplies, cash. Okay, let me get the door real quick. Okay, so I am back. All right, okay, this is going to be a little wet. I kind of like this chalk right here. It's nice and thick. It's a playground chalk. Okay, let that dry a little bit. Let me see if I can. So basically, when we're talking about accounting, so where I learned all the different terms. I learned all the different terms and what they meant. So by the time it was time for the teacher to show us how to do the T accounts, we understood somewhat. But sometimes accounting takes a little time. You have to study. You have to get down in the books. Because you have to know when you're doing your T accounts, you have to know which side to debit, which side, when you debit on the left and credit on the right, but you want to know which accounts are increased with a debit on the left and which accounts are decreased with a debit on the left or the right. So you have to know, because you have a lot. But basically, when you have your cash, when you have your asset accounts, they are usually debited on the left for increase. Say for instance, you have cash, and then you have a liabilities account, which would be let's do accounts payable. Say for instance, you have cash, which is an asset account. So we want to increase the cash, or we want to increase our asset account. We want to debit on the left. Say for instance, we want to open our business. We want to put 100,000 in our 50,000 in our business. We want to debit on the left for increase. And say for instance, if we have a liabilities account, to increase the liabilities account, or credit on the right. So we create an accounts payable. Say for instance, we create an accounts payable. Like I say, McDonald's purchased some inventory. They purchased it on time. They say for instance $20,000 worth of hamburgers. We want credit on the right for increase. So we create an accounts payable. So this is just an example of accounts payable. Increase on the right hand side, 20,000, and it's an asset account. Always remember debit on the left, credit on the right, but you just have to probably study and find and memorize, I guess, which accounts are increased on the left and which accounts are increased on the left or right for decrease or increase. You just have to figure that out. But I know cash asset accounts, you debit on the left for increase. Liabilities account, credit on the right for increase. So, okay, that is that. Like I say, accounting is basically an information system. Like you have other information systems. You have a business information system. I think I have a video previously that I did talking about information systems. So basically, every business that you run, they have some form or fashion. I guess I would say some form of a information system. You create that information system basically to bring that information into your organization. Whatever business you run, it doesn't make a difference. You run an accounting business, you run say for instance, you run a cell phone business, whatever business you're running, you need that information. You need that information within your organization to make those informed decisions. You need that information. You need those accounting information systems or business information systems, whatever information systems you need. You need those systems to make those decisions. Basically, when you're financial accountants, I guess I can say financial accountants. When your financial accountants did generate their information, so for the outside decision makers, like I said, your SEC, your Security and Exchange Commissions, your creditors, you owe people money. You want to create an accounts payable. You want to, they want to know how is this company doing. So they want to definitely probably look at your books. What does the accounting books look like? When you generate your reports within your business, that is the job of the managers, generating the inside reports. Creating those income statements, balance sheets, statement of owner's equity. That comes under managerial accounting. So we generate that information within the organization. Then you have your financial accounting, which generates those reports and information systems that you build or that you create. They are generated for those outside decision makers. So, what decisions do you think you need to make? Yeah. Decisions. It could be some decisions that come up on the spur of the moment, or it could be some decisions that you say, what are we going to do 5 years from now, 1 year from now, 2 years from now? We want to expand our product line. We want to brand. We want to rebrand. We want to change our logos, our labels. We want to try to get our products out into the market more and different. We want to get our products out into different market segments. We want to brand differently. We want to change everything around. We want to change our name. I mean, depends on whatever you want to do. It would be your company or a company that you work for. So it takes those informed decisions. You have to make informed decisions, and you have to have the right information to be able to make those decisions. So you can't say, well, I want to hire 100,000 more employees, and then you don't know how your books are looking. You don't know if you have enough money to pay those employees. 9 times out of 10, you don't want to look at your books. Or you have a department, you have an accounting department, so they make sure they're keeping a tight. I guess I would say keeping a tight hold on those accounting books. So accounting books definitely have to be accurate. So accounting is a system that measures business activities, processes that information into reports, and communicates the results to decision makers. So like I said, you have outside decision makers, which is your financial accounting, and you have your inside decision makers, which are your managers. So it depends on how your business is set up. Sometimes owners do their own accounting books, or sometimes they have a separate accounting department. So there is accounting. And so I talked about decision makers, we talked about accounting, we talked about bookkeeping, we talked about the entity concept, which the accounting entity. An accounting entity is an organization or section of an organization. It stands apart from other organizations and individuals, and it is basically one separate economic unit. And we talked about assets, we talked about our expenses. You have your revenues minus expenses, whatever expenses you have for your business. Your revenues minus expenses, that is what is on the income statement. And that will be revenues minus expenses equals net income. So that's the income statement. And then we have the balance sheet of assets. You want to add up all your assets on the left side, and then it should equal your liabilities plus your owner's equity. So you have your assets on one side. Like I said, we have our assets. We have our assets, and then we're going to have our liabilities. Liabilities plus owner's equity. So that's what's on the balance sheet. So that, and then also that is the initial accounting equation. Assets equals liabilities plus owner's equity. So that is what is on the balance sheet. So assets, whatever your assets are, your liabilities, you have this one equal all your assets, you add them all up, you have one total for your assets. Then you have your liabilities plus your owner's equity, and it should equal up to your assets here over here on the left side. So your balance sheet, your income statement of owner's equity, how much equity do you have in your business, and your statement of cash flows. So we talked about that. Let's see, we did an income statement, we did a balance sheet. Okay, let's move to a few transactions. Let's explain a little bit about the T accounts, and then we do a few little transactions. Basically, T accounts. So basically, if you're just an accounting beginner, I would suggest just study your terms first. Study the terms. Study assets. Find out, be able to list all assets and know what they are. Assets are anything in your business, I guess I would say. Assets are those things in your business that can be converted to cash and can be used for future value. In other words, land, building, office supplies, inventory, your cash account, your revenue accounts, all those are asset accounts. So you have your assets, and then you want to just keep abreast of your terms. Assets. We have assets. Liabilities. Assets, liabilities, revenues. So revenues are those things that revenues are generated. Basically, I say it like this: revenues are generated when you selling goods, or you selling goods in your business, or you are rendering, or I guess I would say rendering a service. You run in a barber shop, you run in a hair salon, like I was saying, like I have Cheryle Cosmetics. I'm selling various oils and hair growth balms and body butters and different cosmetic products, excuse me. So I'm selling different cosmetic products. And that's how I generate my revenue in my business. So you want to learn these terms. Learn these terms. You have assets, you have your liabilities. Liabilities are your debts. Do it like this. First, let's say we have your assets. Then you have your debts, which are your liabilities. You have your assets, which are considered your future value items, I would say. Products, items. Your future value items would be your assets, your land, buildings, office supplies, inventory, and then you have your liabilities, which would be your debts. In other words, you may owe another company because you You create an accounts payable. You purchase some inventory on credit, and then you have your revenue. So these are the basic terms. And then you want to know about your cash account, revenues, and you also have your expenses. And also we have accrued expenses. That means expenses that just continue to add up, but you haven't paid them yet. So those are accrued expenses. So we have accrued expenses. We have expenses, we have cash, revenues, and also, all different accounts. You have your inventory, you have building. So all the different terms, you want to make yourself familiar with those terms first. Assets, liabilities, owner's equity, revenues, expenses, salary expenses, inventory, building, all the terms. You will make yourself familiar with all those. And once you make yourself familiar with those, then you work your way up to the T accounts. So you make your way up to your T accounts. And then you work on like I said, we did an income statement, we did a balance sheet. So we're going to do a couple transactions. So we're at 40-something minutes, okay. So, and this is a book that I learned from. This is a book I learned from Cheryle University. And what we did in the beginning is just show you, it's hard to see. We learned certain terms first, on here, or these terms right here. This is, on this page is who uses accounting information, who needs accounting information. So basically, who needs accounting information? Individuals, businesses, investors and creditors, like I said, your outside decision makers, government regulatory agencies, tax authorities, non-profit organizations, individuals. People such as you use accounting information in your day-to-day affairs to manage your bank accounts, evaluate job prospects, make investments, and to decide whether or not to rent or buy. So accounting, you don't have to work for no big organization or a big corporation. I think everybody should know accounting. Everybody should learn accounting. So this is a couple basic ones, transactions first on this page, and then we go to some other transactions. Okay, the first one is Gary Line invested $50,000 in his business. Gary Line invested $50,000 in his business, so cash. So when it comes to your T accounts, remember, debit's on the left, credit's on the right, debit's on the left, credit's on the right. When it comes to T account, every transaction usually affects two accounts. So if I say Gary Line invested $50,000 in his business, so he created a bank account, Gary Line CPA, or Cheryle Cosmetics. So if I invested $50,000 in my business, Gary Line invested $50,000 in his business, Gary Line CPA, or I could be Cheryle Cosmetics LLC, whichever one, but whichever one, both of them is a good example. So I want to debit on the left because I'm putting money in. Money coming into the cash account, you want to debit on the left. So say for instance, Cheryle Cosmetics LLC, I invested $50,000 in my business. I want to debit on the left for increase, and I want to credit my owner's equity on the right for another increase, $50,000. So that's money coming into the business. So debit on the left, $50,000. I invested $50,000 in my business. Shirley Cosmetics LLC, and then I have on credit. That's how much equity I have in my business now, $50,000. So $50,000 in my cash account, and then $50,000 on my credit, my owner's equity account, $50,000 debit cash, because I'm increasing my cash account. So if you remember, the cash account is an asset account. So increasing asset accounts, to increase an asset account, you want debit on the left. So, you know, you would have to, I mean, you can also check out some of our other videos that I do have on accounting. And also, if you're really, really interested in learning accounting, you can also, you know, you can purchase an accounting book. That way you'll be able to, you know, when you don't have your internet on or your YouTube, you have your book. You can look at your book, you can study. You know, work on your terms, your assets, liabilities, owner's equity, your different accounts, your cash accounts, your inventory account, building account, land, supplies, inventory. Say, for instance, you have a, let's try one. Let's do one. Let's talk about supplies. You have a supplies account. So supplies account, I don't know, you might not be able to see it because the board is a little wet. So that's supplies. The board is a little wet right now, but this is a supplies account. So say for instance you purchase let's say $20,000. You purchase $20,000 worth of supplies. See, the reason why you debit on the left is because you are increasing your asset account called supplies. You purchased $20,000 worth of supplies, so you want to debit my supplies account on the left-hand side because I have an increase in my supplies account. But if you purchase supplies, you had to pay for them. So when you pay for your supplies, you might want to create another account which is called cash. So remember I told you, cash is an asset account. You debit on the left. You want to debit cash on the left because in an asset account when you want to increase. But in this instance, we want to decrease because we want to purchase. We are purchasing supplies, $20,000. We want to debit supplies on the left. We're purchasing supplies. So what we want to do is we want to come out of the cash account. So this time we want to credit the cash account, $20,000. Oh, the chalk is bad. Let me see. Try to switch colors now. Okay, $20,000. Okay, like I said, this is supplies. Okay, we have supplies account. And like I said, this is $20,000. Debit on the left, $20,000 supplies as an asset account. And since it's coming out, we had to pay for these supplies, $20,000, so it's coming out the cash account. I'm going to credit my cash account, $20,000 on the right-hand side. Because I'm buying $20,000 worth of supplies and it's coming out my cash account. This color right here might be a little better, yellow. Okay, let's see. I'm going to do a couple transactions in the book. Let's see. Okay, Smith invests $35,000 of personal funds to start a business. Smith invests $35,000. As I said, always start out with two. So Smith invests $35,000 to start a business. So we want to go with cash. Money going into the business. You want to start Smith. So Smith, I don't know what kind of business Smith had, but it says Smith invested $35,000. So we're going to debit cash on the left side. Smith invested $35,000 in the business, $35,000. So then we want to have another owner's equity account, $35,000. So $35,000. Credit owner's equity. So you always credit on the right owner's equity when there's money coming into the owner's equity account. So that gives him $35,000 worth of equity into the business. Cash. Debit on the left, $35,000. Debit for increase when it comes to an asset account. Excuse me. When it comes to an asset account, you debit on the left for increase. So I'm going to debit my cash account, $35,000 on the left. And credit owner's equity on the right. At Smith will have $35,000 $35,000 worth of equity in his business. So, okay, let's see what the next one is. She purchased on account office supplies costing $350. Okay, Smith purchased on account office supplies costing $350. So like I said, each transaction always affects 2 accounts, but sometimes it may affect 3 accounts, and that's called a double entry. So she spent, well, I think it's $350 worth of office supplies on account. $350 worth of office supplies on account. So we're going to go with what? Office supplies. We're going for office supplies. She purchased $350 worth of office supplies on account. So creating accounts, it's an asset account. So I want to debit on the left. She purchased Smith. Just Smith. She purchased $350 worth of office supplies, so I want to debit on the left because she's creating an asset for her business. $350 worth of office supplies, debit on the left. And so she purchased them on account. So she purchased them on account. I probably would say accounts payable. I guess the company that she purchased it from would be creating accounts receivable. I guess she purchased it on account, so I would go with accounts payable, I guess. I want to credit accounts payable $350. See, she purchased $350 for Smith. It's the name of the lady. She purchased, yes, name of the lady. I don't know if that's a company. It just say in the book it says Smith. So that's $350 worth of office supplies. When a debit office supplies, $350. And she bought them on account. That means she didn't pay it all at one time. She created an accounts payable. Credit accounts, so I want to credit accounts payable $350. So that's how that one goes. So some of these are kind of simple little problems, but those of you that don't know a whole lot about accounting, I had to learn a lot myself too. So in the beginning, I had to learn a lot because of what I had to do. I had to study. Basically, I had to study a lot. And I had to put my head in the books because I was kind of confused with these T accounts. So like I said, every transaction always affects 2 accounts. So the next one is, let's try another one. Okay, Smith pays $30,000 to acquire a lot of land, a lot next to the campus. She paid $30,000 cash to acquire a lot of land. So she paid $30,000 to acquire a lot of land. So we will go with land and cash. See, because when you purchase something, you're going to have to pay for it. You're paying for it through accounts payable or you're going to pay cash. Or then they also have another account called the withdrawals account. When you're taking out money out of the business bank account, you create an account called withdrawals. So you debit on the left, debit the withdrawals account on the left. But she's taking $30,000. She took $30,000 out of the cash account to purchase some land. So since it's coming out of the cash account, on credit cash, $30,000 on the right hand side. Since she purchased some land, she's still creating an asset. So I want to debit the land account, $30,000 on the left hand side. So let's see what the next. I think it's the second part to this. And she intends to use the land as a future building site for her business office. So she intended to use this land for a future business site for her office. So that's $30,000 worth of land. So in other words, she created an asset. She purchased the land, $30,000, and then it came out the cash account, $30,000. Credit cash, $30,000. So let's see what we have next. Let's see. Oh, I'm not gonna go too long in this video. So like I said, you just learning accounting, work on some of your terms, your revenue, your expenses, your assets, liabilities, accrued expenses, salary expenses, work on your terms, then branch off to your T accounts. Remember, all transactions affects 2 accounts. You invested money in the business, $200,000. You invest $200,000 in the business. You want to debit your cash, credit owner's equity. So that's how much equity you'll have in your business. And then, in other words, you can do it like this too. In other words, you have 2 accounts. Say for instance, you invested $200,000. Say for instance, somebody had a business and invested $200,000, and so I put $200,000 here. And then also, like I said, you still have owner's equity, $200,000. In other words, you invested $200,000 in your business, whatever kind of business you're running. You want to debit cash on the left for increase, credit owner's equity on the right for increase. So that gives you $200,000 worth of owner's equity. But then what? And then what if you wanted to take some money off of that out of the account? Say for instance, you invested, you have a cash. Say for instance, you had $200,000. You invested $200,000 in the business, but now you want to take, say for instance, you want to take somebody out and buy some supplies. Do it like this, make it big. So $200,000. You invested $200,000 in the business. You want to debit your cash, $200,000. But now you want to buy some supplies. So you want to buy some supplies. You make sure you have 2. So this will come under 2 up here will be 2 owner's equity, $200,000. In other words, you invested $200,000 in the business, $200,000 worth of owner's equity in your business. But now you want to purchase some supplies off that $200,000. So you have supplies. Say for instance, you want to buy $100,000 worth of supplies. You got $200,000, now you want to buy $100,000 worth of supplies. So that still would probably affect the cash account. That would affect the cash account. So with credit, cash, $100,000, and so the balance would be $100,000 left. So you have $100,000 left. $200,000, and you invested $200,000 in cash. You have $200,000 worth of owner's equity, in the business, and you purchased $100,000 of supplies. And so it would be credit cash because $100,000 came out of cash. Came out your cash account, so your balance in the cash account will be $100,000. So you can still put that over on this side. You took out $100,000 worth of cash. You started out with $200,000. Put it up here too. You started out with $200,000 in your cash, see? Started out with $200,000 worth of equity. You purchased some supplies. So supplies is an asset. Cash is an asset account. You took $100,000 to purchase some supplies, so you created an asset too as well. $100,000 worth of supplies. And then credit your cash account because you took out $100,000 and purchased some supplies, so you bring it back on your left side, and you still have $100,000 left in your business cash account, and you still have $100,000 worth of equity. $100,000 worth of equity in your business. So guess how that goes. And the border was a little wet, so I was trying to, so in other words, to explain it like this, you invested $100,000 in your business, and they created $200,000. Invested $200,000 in your business. That created $200,000 worth of equity in the business. So $200,000 in the business. That created, you invested $200,000 in your business, that created $200,000 worth of equity in the business. Then you purchased $100,000 worth of inventory. Purchased $100,000 worth of inventory, then you got $100,000 left. You got $100,000 left in your cash account, and you have $100,000 worth of equity in your business. So, okay, so let's see what we have. Let me do a couple more because it's already over an hour. Let's see. Let's say Smith locates apartments for clients and receives cash, $1,900. Smith locates apartments for clients and receives $1,900. So let's always say we always got 2 T accounts. So she locates apartments for a client and receives $1,900. So if she receives $1,900, it looks like that will go into cash. But if she locates accounts, apartments. She locates apartments for a client and she receives $1,900. So I would say, I guess I would definitely deposit $1,900 in the cash account. The cash is an asset. That's money coming into the business. So we want to debit on the left, $1,900. And so she, let's see what would be the next one. She locates apartments, so that would come under service revenue. Cash. Well, I mean, I would go with owner's equity. I still would probably do owner's equity. And it's still like service revenue because she performed the service. She located apartments. So there could be owner's equity, $1,900. Also, I don't think you want to do service revenue and cash. I would do probably cash, $1,900. Cash is an asset. She locates apartments. She created a service. She created a service revenue, so that's $1,900 cash. Debit cash, $1,900. But they still give her equity in her business, $1,900 on the credit. Owner's equity, $1,900. So let me try. Let's see what else we have. Let's just a couple more. She paid $2,000 of personal funds for a vacation. She paid $2,000 of personal funds for a vacation. She paid $2,000 of personal funds for a vacation. Well, I mean, I still would say that would definitely, if she paid that, we're still going to go with cash. Well, you know what? That would be a credit to cash because she's taking money out of the cash account this time. So she said that was, what was that? $2,000 personal funds for a vacation. So that don't look like that would come out of business. That don't look like that's a business transaction. She paid $2,000 for a vacation. So that really is not even a business transaction. Yeah, because she paid $2,000 for a vacation. That's not even a business transaction. So sometimes they will try to trick you. So let's do one right here. She paid expenses cash. She pays cash expenses for office rent and utilities. She paid expenses. In other words, she paid some expenses. Rent. She paid some expenses. Rent $400 and utilities $100. So we got over here rent, $400, and utilities, $100. So it's going to come out the cash account. Utilities. So rent $400, utilities $100. So in other words, cash. She paid these expenses, so it's going to come out the cash account, which would be $500. So $500 out your cash account. So if she paid those expenses, we want to put $400. We want to debit the expense account $400, and $400 for rent, and $100 for utilities. So expenses is $500. So $500. In other words, she paid $500. She paid $500 worth of expenses, and it came out of the cash account. So we're going to credit the cash account $500, and debit the expenses account $500. Because you got $400 for rent and $100 for utilities. So anything coming out of the cash account, you want to credit on the right hand side or decrease. And anything going into the cash account, which is an asset account, you want to debit on the left or increase. Okay, let's try. Let's see. Let's see what else we have. The business sells office supplies to another business for its cost of $150. The business sells office supplies to another business. Okay, the business sells office supplies to another business. We'll always start out with 2 T accounts. Okay, this is the last one. Okay, the business sells office supplies to another business. So since they sold some office supplies, business sells $150 worth of office supplies to another company. So they sold some office supplies. We're not going to increase office supplies this time. We're going to credit office supplies. We're taking away. And then we're also, since they sold them, they're increasing the cash account. So $150 worth of office supplies. We want to debit cash. The money coming into the cash account because they purchased some office supplies for $150. We'll debit the cash. Cash is an asset. We're going to debit the cash account on the left hand side for increase, $150. And then since they sold some office supplies, they got rid of office supplies, you want to credit office supplies $150. So that's how that goes. Credit office supplies, $150. Office supplies is an asset, but this time we're not increasing office supplies. You see, if we were increasing the office supplies account, we would debit on the left, but we're not. They're getting rid of some office supplies. They're selling some. They're not bringing that in. Now, if they purchase some office supplies, they would increase the asset account, and we would debit on the left for $150. But right here, they sold some office supplies. That means they got rid of them. They decreasing their office supplies account. We will credit office supplies $150. And then they increase the cash account $150. So sometimes you have to look over it and make sure it's correct. So they did. They sold some office supplies. They sold them. So since they got rid of them, I want to credit office supplies $150. And right, okay, they got rid of them, and then they increased their cash account, so we're gonna debit the cash account $150. So that's how that one goes. So let me see. So basically, if you are a beginner, check out some of my other accounting tutorials, and also they have other YouTube, I guess I would say other YouTubers that has, accounting. They may know more accounting than me. I'm just giving you the basics. So I'm not in I was not an accounting major. Well, I guess I would say like this, accounting was not my major, but I took about 3 accounting courses, and my major was business administration. So I'm just giving you the basics here, but feel free to You know, go online if you want to. Purchase you an accounting book. If you're really interested in learning more accounting, purchase your book. And then check out some of these other YouTube channels that will give you, you know, more insight into accounting. But I think it's good to learn the basics, you know. I want to go further with my accounting too. So I did take managerial accounting as well. Managerial accounting, financial accounting, and I took basic accounting. So I only took 3 accounting courses. So I'm not an accounting teacher, but I'm just giving you the basics. You know, debits and credits. So debits and credits, like I said, always, every transaction always affects 2 accounts. So you invest money in a business, put it in your cash account, open up a cash account, bank account. Say for instance, my business, Cheryle Cosmetics, my oils, my custom boxes, my labels, whatever I need, will affect my cash and my owner's equity. So, say for instance, I'm investing $1 million in my business. Investing $1 million in my business. I want to debit my cash account $1 million. Credit owner's equity $1 million. $1 million, 6 zeros. $1 million. $1 million. Like that. 6 zeros. There you go, yep. So, 6 zeros and a 1 and a comma, and that is $1 million, okay? So, my board is getting a little messy. So, like I said, work on your basics, you know, your terms. I'll have to clean this board. Work on you work on your terms, you know, you learn all your assets. What is considered your assets, you know? Assets, and then you have liabilities. Assets, liabilities. So work on those. Work on your assets, your liabilities, your revenues, expenses, your different terms. Work on all your terms, and then break down. Then proceed to work on your T account. You know, work on your T account. You know, you have revenue. You got a revenue account, cash account. You know, different accounts that you have. So I think I'm gonna stop right here. And I want to say thanks for joining me today. And that was my neighbor was calling me earlier because her son had some apples that she wanted to give me, but I was running my video. I didn't want to stop, but he had some apples, some fresh apples that he had. So I went to the door and got those. But I was trying to complete the video. Complete the video. But like I said, you know, work on your accounting. What I did, I kept my accounting books from when I was in college at Australian University, and so you know, I kept all my books from there, Australian University, and I you know, every now and then I just brush up on my, you know, just practice, but just like singers and dancers, what they do, they practice on their singing, they practice on their dancing. So what's wrong with practicing, you know, going over your accounting terms, you're working on your T accounts, your accounting terms, you know, what is accounting, you know, work on practice doing an income statement, you know, revenues minus expenses, that gives you your net income. Work on a balance sheet. Assets equals liabilities plus owner's equity, and that is on the balance sheet, and that also is the initial accounting equation. So assets equals liabilities plus owner's equity. And then I'm working on my business, so accounting, it comes hand in hand with me. My degree down Australian University was business administration and information systems. Also, we have these little tablets. Also, these tablets are will be on my web page. So, just just a writing tablet. And then, so as you see, I have my logos on my boxes too. So this is what they consider branding. So, branding, logos, labels, and I choose to put my logos and labels on everything. So logos, labels. So I want to say thanks for joining me. And all my branding considers that I have all my labels for my products. These go on my products, my jars and my lip gloss tubes. And so, I deal with Avery. So Avery, Vistaprint, but there's probably some other companies out there. So I'm gonna be branching off. And checking out other companies too that I can I can get my my labels and my logos from. So I want to say thanks for joining me today. And like I said, comment below, subscribe, give me any ideas of anything any new terms or any new procedures pertaining to accounting, comment below. Let me know. I don't mind doing a little research and bringing it right here. I bring it right here. Bring it right here on my board. You have any products you want me to review? Be glad to do it. So like I say, still working on my business Cheryle Cosmetics, and still working on my accounting. So I work on business, I work on accounting, I work on my little business products, and so my little business products. So my little business products. Like I said, these are my labels. See my logos. I say I have my okay. Yeah, there I go. See my logos, my labels, and well then I have different ones. So labels, logos, and all my little jars. So what I do, I make my products using all my different oils. So it's my black castor oil, grapeseed oil, and this is castor oil. Well, I want to say thanks for joining me today, and hope to see you on the next video. So these are my boxes that I have. So they come like this, and then you make them up into the boxes. For my little products that I have that I'm selling on my website. On my website, or just regular. And then I make it up in my jars like this, and they go in my little. When I make my boxes up, when I fold them up rather. So, so Cheryle Cosmetics, and just starting out trying to build my brand. So just starting out trying to build my brand. But I want to say thanks for joining me today. Hope to see you back on the next video. And so like I said, I'll be doing some more. Research so I can find out. Doing some more research so I can find out, different, new material that I can bring pertaining to accounting. Maybe I can learn something about accounting that I didn't learn in my class. So these are my thank you cards. I don't know why it's not showing. Okay, there. Thank you cards. But thanks for joining me. Hope to see you back on my next video. Like I said, you know, comment below, subscribe below. Anything different, any other methods pertaining to accounting, and you think that I can benefit from bringing it right to my channel, comment below, subscribe below. Subscribe to my channel. Give me some ideas, I was just going over the basics, the way I learned it. I learned it through learning all my terms, revenues, expenses, cash account, different accounts, T accounts. So revenues, expenses, cash account, inventory account, building account, land account. I learned it through those, and then learn my T accounts. Each account has 2 transactions. So basically each transaction affects 2 accounts. So that's the way I learned it. And sometimes some of them may affect 3 accounts, but so that's how that go with that. Sometimes it affects according to double entry. So if you have any ideas, you have anything that you want me to present here on my channel when it comes to accounting, basically accounting, law, business, I've dealt with all those on my channel. So, I'll be glad to do a little research and bring it right here on my channel. So I want to say thanks for joining me today. And I hope you have a good one. I hope you have a nice, rest of your week. So I'll be getting prepared for my next accounting tutorial. So I want to say, you all have a good one and keep on studying. So have a good one.